at its highest high. You then divide that by the number of periods again. And finally, you multiply that answer by 100. I realize I just said a mouthful, but don't worry, there will not be an exam on this at the end of the presentation. However, it is important for you to at least understand the big picture. So I've circled two spots marked number of periods. That's simply the adjustable window of time the formula uses to determine the strength of both momentum and gravity. So to keep things simple, let's use 100, meaning 100 days. We're looking to find the right time frame to base a specific trade on. Now, I've circled part of this formula labeled number of periods since highest highs. So what this represents is the number of days that have passed since this stock reached its 100-day high point for the green momentum line. Now for the red line, it's the same formula. You're just calculating the number of days this same stock reached its 100-day lowest low point. So after you crunch the numbers, you take these two scores and you create trend lines for both the green and red lines. At 2 points, these two lines will meet, meaning both forces are equal. Then, at the first point, the green line will continue shooting straight up as the red line falls. The first X will appear. When they meet again, the red line will be the one rising as the green line is falling. Their paths will cross, creating the second X, just like you see here. These two X's generally signal a 48-hour window for when you should enter and exit a trade. For instance, what we're looking at here are the X patterns for railroad heavyweight CSX. On January 7, 2008, the green momentum line shot up as the red gravity line fell. They met when both achieved a strength score of 20. And just like a bullet as it exits the barrel of a gun, CSX entered into a state of high velocity. The stock shot up 45% over the next 8 months. Until on September 3rd, 2008, the tables turned. The red line shot up as the green line fell, when both equaled 30. Then, just like that bullet hitting that metal target, you can predict what happened next. CSX's stock plunged 53%. Fortunately, by following the X's in and out, you would have claimed that 45% winner. Now, at first glance, this chart of Arena Pharmaceuticals appears to be a post-IPO catastrophe. It debuted at $25 a share in the year 2000, enjoyed a short-lived run, reaching the higher 40s. Then it fell into a share price death spiral for over a decade. It hit rock bottom at only $1.25, 95% below its IPO price. So for many investors, Arena Pharmaceuticals are two words they never want to hear uttered out loud again. But the story would have been dramatically different if those investors knew how to spot this X pattern. December 2nd, 2011, the green line shot straight up as the red line fell. They met when both equaled 60. And then look at what happened after the X pattern appeared. Arena Pharmaceuticals entered a state of high velocity. The stock rose 250% over the next 11 months. Then, on November 2nd, 2012, the red line shot straight up and the green line fell. They met at 10. Shortly after, they formed a second X pattern, and Arena Pharmaceuticals stock fell by 50%. However, the two X's would have saved you and your money from a similar fate and allowed you to pocket a 250% windfall instead.
Yeah, just put the X on the other computer. The one that's you should run.
Ticker ANDE. Given its industry, Anderson's took an extra severe beating during the recession, crashing from $30 a share to only $7 a share. And for a long time after its recovery, the company's stock was just battling to hit a break-even point. But look at November 5th, 2012. The first X appeared. Anderson's then entered a state of high velocity. And over the next 17 months, its stock shot up 131% from $26 to $60 a share.